Morning, I'm Daryl Jones, Director of Research at Hedgeye. Welcome to the Macro Show for May 22nd, 2024. Welcome to all the new people joining today. I don't normally dress like this, but I have to go to the city tonight for an event with one of our larger subscribers, and then we also have business planning, so I thought I'd wear a tie and channel my inner Brian Burke.
You look very good.
Yeah.
Very
I have shorts on underneath. But, yeah.
And by the way, he's single. So for those of you that are new to the show, thank you. That's a little piece of new information for you. If you're new to this, again, today's the free day that we're doing. Whether you're new to either our community or our process, there is a different language. All right, there's certainly a different culture. There's a different process and different language. So if you hear things that you don't understand, get in line. That's going to be part of the process. Don't forget that we made up this process. This is a different language than that of the old wall, or God help you if you've still been watching CNBC. So again, get better every day is what we say to the community. That includes everyone, including me. I can only get better at coaching, as everybody knows. So again, get better. If you don't understand something, look it up. We do a lot of teaching. There's plenty of educational videos that go alongside the language that we speak, whether it be trades, trends, and tails. We're talking about price, volume, and volatility instead of simple moving monkey averages. And we love monkeys, right? I just don't want to be my former self. I was a monkey. Everything we criticize, by the way, for those of you that get triggered, it's because I used to do that stuff. Not very bright. Okay, let's keep going here. Top three things we do every morning. We highlight the top three things in all of macro so that we are not macro tourists staring at the thing of the day, which is, of course, today, Nvidia Day is macro tourist day. But last week was CPI, and if you did the opposite of what happened on CPI Day, you got paid. We'll get into that. Europe interest rates, of course. And we will frame Nvidia within the context of both the volatility of the U.S. stock market and the process with the catalysts fully priced where it is going into the event. First on Europe, simple one, buy the damn dip, all right? We got 4 different European exposures. We just added France in Portfolio Solutions. You can see that Portfolio Solutions is my long-only family account. We call it the MOFO, or the Mucker family account. And you can see every single position in there. Yesterday on red, we added France, EWQ. And again, on red today, we would add and start to build the position up from 2%, which is my minimum asset allocation for an equity. So we got France, we have Germany, we have Spain, and we have the Dutch. If you ain't Dutch, you ain't much. And you know that if you haven't been long EWN and not capturing that ASML action that it has, a highly concentrated component of the EWN. Now you know. That's been a great one. European economic data continues to accelerate into what we call quad 1. Okay, now interest rates. This is a good day. It's a really good day. Think about the macro tourist day last week. Everyone's like, oh, benign CPI. Austin Goolsbee, it's a Hall of Fame year. Whatever, okay? If you did that on last week when bond yields went down, if, for example, you bought TLT or IEF, anything that's duration, that was not a very good decision. The decision to make was higher for longer. So when we talk about higher for longer, we talk about Fed policy, not within the narrative of the guy playing the guitar, the Leisman thing, or whatever people are just yapping about on CNBC. We're talking about what does the bond market think? The bond market continuously front runs the Fed. It's not about not fighting the Fed, it's about front running the Fed. So again, we're going to get into this, but again, higher for longer is what we just priced into the short end of the curve. That means that the 2-year yield has gone up 13 basis points, again, since that day last week. Straight up, and it was augmented today by the UK. Again, if you're just going to talk about interest rates, you better talk about interest rates, right? It would include the 10-year Japanese government bond yields up to 1.00%, which is a big move for that, up 12 basis points in the last month alone. You have European bond yields moving higher, and UK 10-year bond yields up a full 10 basis points on the UK, putting up a hotter than expected CPI. Not benign, hotter than expected. Hotter, hot, like magma hot. Remember when you used to own all that stuff? I mean, so here we go. No matter where you are, this is bullish for, again, bond yields, higher for longer on inflation. We have the street high estimate on inflation. We have inflation going towards 4%, not 2%. Street has it going towards 2. We have it going towards 4. If we're right on that, I've said it many times, it's going to be hard to get the 2-year yield below 4.5%. Never mind below 4%. So in everything that you do, think about it as a human being, as a person, as a head of a household, or somebody who wants one, as a corporate who might be geared or levered. Again, higher for longer on interest rates is our baseline assumption. It's been our assumption for the last 6 months. That's why we're crushing it on the long side of commodities, which is the best way to be long of inflation. We show those top 5 performing ETF buckets out of 2,800 ETFs. ETFs, you could be long or short right now. Look at the ones that are performing. Look at that early look. If you haven't read it already, that's the pregame. Okay, these are the pregame notes with a lot of strategy. I write it every day. I've written almost 3,000 of these. 3,000 of these bloody things. Lots. Okay, so again, the top 5 positions, if Genron gets to it, you'll see what they are. They're basically all miners. So whether you're long silver itself or the miners, look at the returns. Like, that's savage. That was the title of the early look. It's just savage. Yeah, it's like Attila the Hun savage. Yeah. Up 40, 50, almost 60%. Now we're talking alpha, okay? So there you go on that. Finally, on the VIX and Nvidia. You can't look at one without looking at the other. So what we like to focus on using the Tier 1 alpha data is, again, where is super short-dated structure on the curve? So again, super short-dated volatility. See where that green arrow goes up? And again, this is where some people are like, I've never seen anything like this. All they do is talk about the 50-day and the 200-day on CNBC. Shaggy? Yeah, like, really, park your old self there. There's a reason why people don't watch Scooby-Doo anymore, or at least not in my household. So here we go. That's up. And it's up almost 5.5 points versus where it was yesterday. For those of you that are new to that, that's a lot. That means, and this has been very consistent on macro tourist days, whether they be jobs days, jobs reports days, CPI or Nvidia in particular, you get people all of a sudden, okay, I'll buy protection the day before. Now, this has actually been a buying catalyst because people putting on protection, if Nvidia beats or beats by a lot, it doesn't really matter what it beats by, does the stock go up? And we have it going to 975 in an upside scenario. So again, it's bullish trade, bullish trend, and has higher all-time highs in play. It made a higher all-time high yesterday, closing at 953. Prior all-time high closing is what matters in my model. Closing prices. If you've never heard anything about that, close your old process. That's not a process. Using moving monkeys? A 6-year-old with an internet connection could do that. Get better. Come on, here you go. So the Nvidia setup's really interesting. Again, we're not saying that the street isn't crowded into it. The trade was actually to buy it when it was at the low end of what we call our risk range, weeks ago. And again, we told you to do that on the macro show. So today you're just selling some anyway because that's what you do. You don't bag hold these things. No, not into events. And those are your top 3 things. All right. Today, Jonesy, I went back.
By the way, your notebook seems fuller than usual today.
Well, it's
I see a lot of circles, a lot of highlights,
lots of stuff going on here.
And I think for the new people, we can talk maybe briefly about that part of the process because I've obviously known you since college, but started working together 2 years after college, and I think you basically started, which was 20 some years ago, started doing a daily investment or research notebook, and have continued to do that for the past 2 decades. And there's a lot of technology in our process. There's also the manual part of the grind of getting up every day, writing it down, holding yourself accountable.
Yeah, these aren't doodles, right? The number that's highlighted here, 1385, that's the top end of the risk range for the VIX being a lower high. That matters mathematically and empirically within the fractal lens that I use. Got it? Some of you don't, if you're new to this. But if I don't write it down, let's just start with one very basic reality. I'm not smart enough not to write it down, okay? I'm not an intellect. I'm not as smart as Jim Cramer in his own mind. No. I'm a mucker. I'm a grinder. I have to write it down. It's called deliberate study. So I take all these things that we use, AI models, fully loaded stochastic, again, modeling process that gives us our inflation and growth nowcasts, all the company models that we build. On CNBC, none of these people talking have any models, never mind writing it down, and maybe that's the point. They don't write it down because they have nothing to write down, right? Nothing that's unique. Quoting a valuation of a stock using Yahoo Finance, again, a 6-year-old can do that. So what I do is a function of me needing to constantly get better at communicating to you what I'm going to do. If I went back to running my hedge fund, I would still write it down, but I wouldn't have to be as explicit in my notebook, okay? Because I'm, again, trying to get better every day like you at coaching in my case. Being a player is easier for me than being a coach. And I hope you can empathize with that. If some of you come back that have canceled because you just didn't like me as a coach last year, in July I got smoked, right? I've been smoking it for 6 months, but I got crushed, like publicly crushed, and I liked it. Not really like it. I hate losing more than winning. But that said, I was accountable to it. So again, and we evolved the process. We got a lot better coming in and out of that as a team. So quite happy about that. Another thing that we do, by the way, every single day in the early look, if I'm writing it, I'm citing a longer term time series. So it's one thing to have immediate term trade ranges on the VIX, like again, 1385 is top end of the range. If I didn't write it down, how would I remember it? Right? But then take that and spread it out across 2,000 to 3,000 years of history. And you tell me if this geopolitical risk that is a component of being long oil, but it's certainly not the leading component of being long oil, is over. We would say no. Our geopolitical risk strategist, Colonel McCausland, would say no. This is a war of religions, okay? Muslims, Christians, Jewish people, they're all, this is going to go on and on and on. So again, we will learn, and we'll, the only thing I read are books, right? Okay, I'm not going to read some sell-side bullshit, like some paper from Goldman Sachs saying that we think that the inflation number was benign. It's a complete waste of my life and cycle time, all right? The most precious time you can spend is on your process. So if I can get good, try to read a book every 10 days, try to get better at learning what I don't know. I can only learn every day. That's my starting point, and I hope it's yours. It's certainly that of our communities. Sometimes the coaching's hard, right? We're not for babies and crybabies and wussies. No. I said wussy with a W, right? That's not what this is for. This is for people who are actually accountable to themselves. When they look in the mirror, there's a transparency exercise like, that's on me. I think of that every single day, and I want you to too. Okay, let's get into the process. So what we do after the top three things, after a bit of a rant there, is we show you, again, we go through the notebook. So again, I show you what is the S&P 500 risk range. Well, why am I writing it down? Because some of you don't subscribe to the risk ranges, so you don't know where it is. 53.65. So this would be a higher low for the cycle, and this would be a big higher high. And that's within an all-time high. Okay? So that's the most bullish setup in our quantitative signaling process that you can have. It's bullish on our immediate-term trade duration. Gendron, show the durations. Trades, trends, and tails. It's bullish on our immediate-term trade duration, bullish on our trend, intermediate-term trend duration, which is 3 months or more, and it's signaling higher highs to all-time highs. Me love you long time. Yeah, that's what those are. So again, those should be your biggest positions. We re-rank daily my Portfolio Solutions product, which you can see the ETFs, gets re-ranked for signal strength. Signal strength is what I just showed you. If it's losing signal strength, it's showing a lower top end of the risk range. It's starting to break my immediate-term trade level support and then breaks trend. Oh, Meta. And my analyst makes a call on Meta rate as that's happening. Kaboom. Tick, tack, that's what we got. I mean, those are the kinds of setups you want. If you're in the Rangers and you're in the slot and somebody gives you that open pass, you better bury that thing. So again, we buried Meta on the short side. Meta and Tesla are the two weakest stocks in what we call our momentum tracker product. The strongest signal strength mega cap that everybody owns is Google. All right, what else we got going on? So then we dig in a little bit. What did volume do? So again, when I talk about a market price or a signal, trade, trend, tail, that's multi-duration. Write it down. I talk about multiple factors. So I'm not going to be like a monkey, like a simple moving monkey. That's a one-factor price model. That's why they're monkeys. That's why I call them monkeys, right? I used to work with bosses that use those. I stopped using them because they don't work. What works better is the relationship between price, volume, and volatility, and specifically the volatility of volatility, okay? Now, I'm not going to give you my algos today, but I'll give you the outputs of the algos. So again, you can see that one of the big inputs, top down on the market on the S&P signal, was that you had a monster acceleration in volume. So again, when we get price to all-time highs, signaling higher all-time highs, and up days, again, it was a closing all-time high yesterday for both Qs and the S&P 500, that's the most bullish setup you can have, because price is, again, augmenting my signal. You wouldn't just look, and again, it's the rate of change of price, as you could see on that table. What else we got going on for you this morning? We also look at implied volatility. I mean, now we have a pretty complacent setup after the move. Now, if you look at something like this, which all of our subscribers are very well aware of looking at, if you show like Chrome Dome Kramer's #1 fanboy like what this is, it'd be like, huh? Trading? What is an implied volatility setup? So let's look at Qs. So for example, which we're bullish on, Qs has a -6 implied vol discount. A month ago, when people were losing their shite on this, it had a 53% implied vol premium. That's because throughout April, volatility went up, and the premiums for puts went straight up. And then in the month of May, all that got reversed.
So I was going to say that's when there's a high implied volatility premium. That's basically fear, right?
Yes.
People are paying more for puts. And then, typically that's the contrarian signal to think, potentially think about buying or
Yes.
put it on your radar screen.
And instead of having to do these calculations on your own, by the way, if you don't have a Blueburn machine, you probably struggle unless you know how to do it on your own, which is entirely doable. Plenty of our subscribers who don't have a Bloomberg can do that because they do math. They don't do moving monkeys. Again, we color code it. So again, something that goes deeply in diving red from very high in terms of positivity or green, it's the opposite in terms of behavior. So now again, you'd be a seller of strength if you're actively trading your longs, if you're long Qs in particular. And that's same thing with Google, by the way, which again, like I said, it's Google, Net, we reviewed this yesterday, the top 3 on signal strength in the momentum tracker are Google number 1, Netflix number 2, and Nvidia is still right in there like a dirty shirt at number 3. What else we got going on for you this morning? We also look at what we call the bongo board, the sector setups. Yesterday was a good buying opportunity in industrials. So we buy them when they're down. We don't chase them when they're up. And yes, that makes our community different. And yes, we are, some call us a cult. You'd be called a cult, you dirty little mucker. That's with an M. Are you listening? Mucker, right? I buy them when they're down, provided that they hold immediate-term trade support, trend support, and remain bullish from a quad perspective. So in quad 2 and quad 3, we're currently in quad 2 from a monthly perspective. Show slide 29, guys, the monthly quads. You're going to buy industrials on every damn dip, especially get bigger at the low end of the risk range. I shouldn't say at every damn dip. If it's just the first dip off the top end of the range, of course, we're not going to buy that. But we will buy the damn dips when we see us going from a quad 4 in the month of April to back-to-back quad 2s. Remember what happened in quad 4 in April? Our Hedgeye community did. We weren't long all the stuff that they were long. Growth gets smoked in quad 4. We stayed long of inflation, and that kept us alive. And that's good. And obviously in May, we've been crushing it on both, being long growth and inflation. So that's another way. Cyclical growth is what I'm really exposed to here, whether it be energy stocks on that bongo board, XLE, XLIs, industrials, and basic materials. Inflation, another way to play that's been insurance stocks, IAK, KBWP. These are all part of the core asset allocation. They've been working out as they should. A couple things, cross asset class vol. Has anybody ever taught you about this? Whether I get things right or wrong, by the way, I get plenty of things wrong. I have 8,000 timestamp real-time alerts going back to 2008. Again, we started the firm in 2008 with the bear call that the market was going to crash. That worked out. We went bullish in April of 09. Who cares about yesterday? Let's focus on today. The MOVE index is breaking down, right? In the words of the great Matthew McConaughey, that would be green lines. Green lines. Yeah, they're better than red lines. Why? Well, when the red one was going up and the quad 4 was happening, these are optical illusions. They're the same color, right? When those two things are happening at the same time, you have rates volatility breaking out. Stocks do not like dollar up, rates vol up. Rates vol up. Now we have rates vol breaking down, dollars still steady and strong, and we have stocks up. Now that's the setup you want, because what's happening is that the bond market's saying, they're not actually going to raise rates, which they thought in April. It wouldn't be a cut, it could be a rate hike. And then after the CPI, they're like, oh, I get my rate cuts back. Yeah, it's like you're going to have 3 or 4 or 6 rate cuts. Nope. Now it's one and done on rate cuts. That's what that's telling you. That's all you need to know. If you don't know what I'm saying, read the early look. I got to keep going here with the process to keep this thing moving along. What else we got going on? High yield, again, cross asset class vol. We're thinking about, again, adding to high yield long positions, HYG or LQD, which is investment grade credit. As you continue to see, show the chart on credit spreads. So 10-year, if we look at 10-year corporates, triple Bs, you can see those have continued to go down, Jonesy. If you go back even to where people are like, oh, we're bearish on stocks and credit. Yeah, when that thing went to the high of the chart, yeah, we were. We were the only firm to make the turn from 2021 to bearish on stocks and credit. But that thing stayed elevated all the way up until the end of the third quarter last year. Now, the end of the third quarter of last year is when the global recession ended. Slide 35, you can see. This is where China was in a recession, Europe was in a recession, big countries in Europe, in particular Germany was in a recession. The UK was in a recession, Canada was in a recession. So the recession's over. And what's happening is that global credit spreads are going down as markets and prices of commodities in particular reflate. or inflate to levels that we haven't seen in a long, long time for things like copper, in particular silver, the things that I showed you that were long. So we got that. Then we dive in one more level. Okay, let's just do this one more time. We'll do tier 1 alpha data. I showed you the setup with the calendar. So show that count. There are 3 things. A, B, C, test this. The calendar, we already went through that. They're pricing in, some risk here on the Nvidia event. That's good. If you were long Nvidia 3, 5, 10 days ago.
That's actually increased a fair amount too, right?
A lot, 5.5 points. Point 2, the flip line for volatility. Do you know what that is? Even know where it is? So knowing where it is helpful. This keeps, again, dealer gamma in a positive regime. Anything north of 53.01, the flip line. Again, look that up. We don't have time to explain. 1 month is inside a 3 month. That's super bullish. That's one of my most indicative signals of falling volatility, lower highs and lower lows for the VIX. Gives you that. 1 month dives through 3 month, super bullish, and that has been. And again, this is not new as of this morning. So I guess a tourist or a CNBC type would be like, man, this guy sounds pretty loud, first of all. This guy sounds like pretty bullish. Maybe I should buy today. No. You have to have the patience to wait for corrections. Buy industrials if you're going to buy something today. Don't buy something that's at the top end of the risk range, which we publish across the board each and every day. We also show you the flows, in terms of what's impacted the model. Yesterday's biggest impact was actually Tesla. So today's biggest selling opportunity is Tesla. So look at the Tesla 190 puts, the 185s, whatever. Like yesterday, they're right back to the fun and games. When we're hitting all-time highs in Qs, they're buying the weeklies, and there is a they in Chicago that perpetuates the retail investor behavior. We know how that goes. They just chase, right? They buy short-term YOLO call options. You'll hear things from these people, and maybe it's you. Only invest what you can lose. I mean, the dumbest shit I've ever heard, okay? This community is here to preserve and protect the pile, to fade, especially when it's a bearish trend like Tesla, at the top end of the range. So you got that from the market yesterday too. Let's do global. I'm going to have to get this done pretty quickly. But again, India, long India and long commodities. We'll show you those 2 things. They're very good examples. And some people accuse me of being short term because I'm the only person that talks every day, that actually has a process that he shows every position every day is what I meant by that. But we bought India in June of last year. You notice the red arrow? If you owned it into June, you're getting your ass handed to you? No, we bought it in June. That's been a great long-term asset allocation. Long-term, right? Short-term is the risk management exercise. Long-term is what you hold in the core. So we're risk managing around that, sizing the positions up, sizing it down. You saw us buy like a ton of India 2 weeks ago when it was correcting. Now I'm selling some because it's bounced towards the top end of the range. So there's that in India. We're long China too. KBA is the ETF on that. Very few weak signals in Asia. I mean, Taiwan, for example, was up another 1.5% yesterday, again on the heels of this. Again, we had 7% industrial production growth in China last week on Friday, which has really inspired these markets to go higher. It's not just all about the Fed or watching one thing. That would make it easy, wouldn't it? We've gone through a lot so far. Europe included, fully loaded. How about commodities? Do the same thing. We were bearish on commodities for all of last year into the end of the year. The red arrow ends when we stop being bearish. How do I stop being bearish? Well, I start losing money on the short side. So the signal says, hey, dumbass, get out of that. And we got long. In whatever, January, February, picking whatever commodity you want to look up that we've been long a lot of commodities. So again, very good example. If you can't see the inflation because you listen to people who are politically positioned to tell you otherwise, just show them that. Butter, lumber, cotton, orange juice. Bullshit, okay? Bullshit. Unequivocal bullshit that inflation is benign. Inflation's up 20% even using the CPI in the last 3 years in the aggregate, and it's rising, and we think it's going towards 4% by the end of the year on headline CPI. Okay, what else we got going on for you here this morning? A big opportunity potentially to buy copper? I don't know. Copper was right at the top end of the range yesterday. Most of these things were at the top end of the range yesterday. That's why the CRB index, which is 19 commodities, was near the top end of the range yesterday. So have some patience. They are commodities. They trade with higher beta. Okay. The corn is up for us. The corn on the cob this morning. That's one we just recently added for the fam, up 0.8%. I should have added wheat, which is up double that. So wheat, again, all these things you're seeing. Again, you're seeing a broadening of the inflation view, not a narrowing. Okay. If anything, oil's been left behind in the most recent weeks, but again, I'd be a buyer of the damn dips on that too. Low end of the risk range on WTI is 77.51. Again, these are all in your risk range product. I already hit on bond yields. Already talked about twos and what that's saying. So again, no hikes, but less cuts. Maybe one cut. That's what we got. and a good spot. Bitcoin, crypto, they've all gone quad 2, which means that they all go straight up. Again, signal was right on time on those things as well. We're bullish. Bitcoin and crypto, we differentiate the two. They're not the same thing. But in quad 2, you can be long everything from meme stocks to crypto, things that I think are complete bullshit. But I'll be long bullshit because I know that Wall Street's full of shit. That's fine.
Okay, you may have kind of hit on all this already, but you wanted me to start off by asking about the Momo tracker. I did think it would be worth kind of getting into, in particular, Nvidia a little more, especially ahead of earnings today. Obviously still bullish on all of our durations, but we did highlight the IVOL being at a discount. There's a lot of dynamics here. Hedging has increased into the event, so there's a little more caution in the options market in general around it. But just kind of curious to get your thoughts on all that.
Yeah, I was just pulling it up. So the momentum, it's called the Momo tracker or the momentum stock tracker. Right in the headline, actually, Generon, if you can show that. It tells you all you need to know. I've basically summarized it before I showed you this. But again, I'm summarizing because I've already reviewed that, wrote it down. Right? So we have Meta near the low end of the range. That's why it says Meta down. It's got like, in terms of its downside, it doesn't have much from here for today and the day after that. If it bounces 4%, it'd be back at the top end of the range. What it says on a risk range tracker for Nvidia, Jonesy, is plus 2.2 and minus 8.2, right at the top on the headline. The headline of what the note says, right there. See, so plus 2.2 is the upside in the risk range. What that means is, let's just do this, Nvidia. So Nvidia checks all the boxes, right? Nvidia, is it from a trade perspective, immediate term trade, a trend perspective, that's intermediate term, 3 months or more, and then from a higher high perspective within all-time highs, all-time highs. I can still spell. I spelt it right. Look at that. Check, check, check. Right? Forecheck, back check, paycheck. When something looks like that, so now all we really need to do is solve for the risk range. So when it says risk range minus plus 2.2 versus minus 8.1, hang on, minus 8.1 to plus 2.2. I think that way because that's the way the range is. That means that this number here is around 975, and this number is around 876, if I recall correctly, from a 953 close. See how it helps when you write down the numbers, you remember them. So again, that's the setup. If Nvidia were to go down 8%, nobody should be surprised. If Nvidia were to go up 2%, nobody should be surprised. These are the probable outcomes based on, again, our sophisticated risk range tracker. So again, if it were to go down that much, it would not be bearish trend. Right? That's the thing about it. It has so much bloody momentum, that it could correct 8 to 10% and nothing will change in terms of the fundamentals. Now, that can change within days of that changing, and that's when the thing changes. So we don't tell things when to stop going up on valuation. Well, when you look at the valuation, they're super really interesting things to say, but they're completely useless. They don't have anything to do with what people are going to do in Nvidia today. This setup does, and where the options are traded. So that's the point, Jonesy.
Yeah.
The momentum tracker product. Every single day, Generon showed what he should have shown at the beginning, which is the upside and downside and all those things.
Yeah.
And when there's a lot of upside, even in a short, it's not a lot of upside, 4-to-1 upside versus downside on Meta. I'd be covering some Meta shorts yesterday on red.
Okay. Question from John Gibbons in Newfoundland, and this is actually something I tend to struggle with a little bit too. Good morning, Jonesy and Keith. Keith talked about how he doesn't want to go beyond 40 positions in his long-only account on the macro show a little while ago. And again, this is what's in Portfolio Solutions. How do you manage your position sizing as the number of tickers increase? Despite pruning and planting the best I can, finding it challenging to have room to gross up positions without having to violate my minimums or remove positions. And we've talked about this before, but for me, I actually have a hard time having, let's say, more than 20 positions because I feel like I'm just not on top of them, right? So for me, the right number tends to be 15 to 20. And I'm not overly aggressive or anything, but once I get to have too many positions, it's like I start forgetting stuff, and that's that's where it's just I don't like watch it as closely as you do or other people do. So for me, it's just easier to manage.
There's a solution for that because your problem is entirely human.
Yeah.
You're like me. You don't have enough brain power. So I've built machines to do that for me, so I can do it quickly.
Yeah.
So I can go through, I said 40 on asset allocation I can handle. I'm probably closer to 55, 60 positions with single stocks. In my, that I can do. With the modern machines, I can do. The question on when you're fully invested, that's not a problem. That means that, again, if you're decked to the halls can you show today, I don't know if Rooster's top 25, I showed the top 5, but the top 25, again, ETFs that you could have been long here for the last 3 months, they're absolutely smoking the alternatives, which include, obviously, 60-40 portfolios, which are decked to the halls with TLT or long-term bonds, Russell 2000, et cetera, et cetera. So it's a high-class problem. When you run out of room, it's like having 4 kids. Laura's like, thanks, we're shutting this down. That's good. If you're blessed with 4 children and they're all healthy like mine are, and my wife says, no bueno, believe me, I could have had capacity for 5. But it's not a problem. It's not a problem. And one of the best things that you can do is really, if you're trying to make room, it's not like you can, some people get rid of their kids, but I mean, you can't just these aren't kids, these are tickers. And I want you to really embrace that thought, is that Wall Street is in the business of selling you stock. That's it. You got that, right? CNBC is in the business of selling advertisers ad space. That's it. We're in the business of helping you preserve and protect your pile and compound alpha like that, right? That's what we're in the business of every single day. That's the job, right? It's called Hedgeye. It's like looking inside of a hedge fund. What would you see? Well, this is what you see. You may not always like chubby me, but it is what it is. So what you look for, Jonesy, in this situation is something to get rid of. And they're just tickers. My life is uranium. You see this, right? People have to have some evangelical experience with their long-term holdings, these bag holdings, right? We've risk managed uranium beautifully. Uranium is one of our asset allocations. But yesterday I got rid of shipping, BDRY.
Yeah.
Why was BDRY down? Well, Hedgeye Nation, if they're listening to the process, they sold the rest of it. It had moved down the list because that's what happens when you lose signal strength. You don't buy more on valuation, you sell some. One of the simplest lessons you've never heard from people, ride your winners and cut your losers, right? That's what we're doing here.
It's sort of interesting. Actually, I'm going to give myself some credit, but I think where I have improved is on the loser side. I don't get emotionally tied to a position at all. I have my stop, at a certain point I just stop out and move on. I did something that was kind of new for me yesterday, which was, we were talking about, I was, sort of had this ETHE position, which I meant to sort of trade around. I never did. I just held it. And then in a week, the ETF's up 50%. And I was yesterday kind of trimming it. And I'm like, I'm just going to sell this thing and take the profit. Never in my life has an ETF for me been up 50% in a week, right? And I think that's part of it too, where you also can't because if something goes up 50% to down 30%, you also lost money there, right?
Really?
So
you don't say.
So I think
you think that these people who just discovered dollar cost averaging, which is a Dumbo thing to do, unless you're Vanguard trying to sell it to people, you think that it was the other way around.
Yeah.
Right. You can lose a lot of money bag holding.
Yeah.
Right. So why not lock it in?
Yeah. Yeah. So exactly. So I think there's 2 components. There's the losers, and then there's the winners, and think about how to deal with both of them.
Yeah, just a couple things before we go here, because I mentioned things that I didn't draw on. Ethan, can you show the slide 35 with the global macro quads from a quarterly perspective? What I showed you was the monthly quads from a USA only perspective. So again, what we want you to do, what I say at the top of the show, just to review, I got to go trade, so I got to round this up. Eurozone, this is what you're looking for. You're coming out of a recession, which ended right here in the 3rd quarter. When I say Europe's recession ended, that's an empirical fact. If what I'm saying is not an empirical fact, you fact check me, I'll either say, wow, I misspoke. Could happen. I'm doing all of global macro, 50 different countries, all asset classes, all tickers with each level in things like Nvidia. I will get things wrong, but I won't say that's right. When we talk about getting long Europe, we're talking about quad 1 or 2. That means the economy is accelerating out of a quad 4 recession. Very specific, right? The risk management exercise from here in the USA in Q2, which is again right here, is to go from monthly quad 2s to quad 3. That's going to be a big thing. So the number one question our community will ask, Keith, when? When do I do it? And the answer is I don't know. I'll do it when I do it. We do what markets are doing. We don't tell markets what to do. Okay? So that's going to be a real critical exercise. And again, when you look at the world, don't forget that the median and mode of the world by the fourth quarter is global quad 2. So when you think, look at all those things, copper, silver, anything, if you dropped it on your head, it would hurt. Those types of things are sniffing out that by the end of the year, anyone who didn't know that inflation was going to continue to break out throughout the year missed that the world came out of a recession. And that's another thing I said. These are just quantitative facts, empirical facts. And that's one of the biggest things I think people are missing while they have these macro tourist days, is what is the global economic cycle doing in and of itself.
All right, we're going to wrap it up there. Thanks, everybody, for tuning in. Back at it tomorrow at 9 a.m. Take care.
Hey, good morning from the control room, everybody. I'm Eric Gendron. If you're new to this place, I'll push the ones and twos back here to make Keith look good. Thank you for joining us. If you are new, we hope you would subscribe to the Macro Show and all of our products. Check out hedgeye.com/research for all of our research products. If you are a Hedgeye subscriber already, but you're new to the Macro Show, highly recommend checking out our education center. That's right at the top of our website. Go to hedgeye.com. You can also Google it. Just Google Hedgeye Education Center. That's a fast way to find it as well. But we hope you come back. We hope you like what you saw. And good luck out there. Have a good day.